Well, I am jumping on to do a bit of a PSA announcement and more of a reminder of what to do and what not to do when we hit turbulent times in relation to investing markets, your superannuation account, your investing account, all the things. A couple of things I will say before we hit go on this. I'm recording this on Saturday, the 5th of April. It will be going up on the Money podcast on the 7th of April on the Monday morning. It will go up on Retire Right on the 7th of April on the Monday morning. It will also go up on the 14th of April on the Financially Fierce podcast, because what you're about to hear is an episode I'm recording today with Jess Brady from the Financially Fierce podcast. It's a podcast that we produce for Jess, and she was booked in to come to the studio already today on the Saturday, and over the last 2 days, I woke up to the S&P 500 falling on Friday morning, 4.84%. Woke up this morning, opened up, and America closed negative 5.97. So we're basically in correction territory, and we may cover this in the podcast episode, but just I'll put it here in the intro. Correction is usually 10 to 20% drop within a matter of weeks. A crash is usually a 20% drop within a matter of days. So we're 100%, I think we've ticked the correction box, but what I wanted to do is do an episode today about what to do, what not to do, but say what to do one more time. But what I wanted to do was, we were going to do an episode with Jess anyway for her podcast. Financially Fierce is a podcast that, actually, Jess, tell us a little bit about the Financially Fierce podcast for the Money audience and the Retire Right audience, because once we press go, they're going to hear your podcast. Mm-hmm. So should I be scared?
No, not at all. I mean, it's another money podcast. I'm a financial advisor. I've been in financial services. Actually, it's nearly 2 decades this month. And so, you asked me to come and give my own perspective and lens on the money world, and it caters for everyone. You got it. You got what you asked for. We have listeners from all around the world, but from every age group, from every income band. And I try to bring, practical insights that help people understand how to behave better with money, how to think differently with money, but also how to grapple with what often can be challenging conversations and times with money, exactly like what we're going to go through today. Yeah,
and I think the reason why I wanted Jess to do her Financially Fierce podcast, because one, you're crushing it with the stuff that you do. Jess runs an online money course and the greenhouse, and you'll hear about that as part of her podcast, the package that we'll play. But we are different people. I mean, I'm much older than you.
Much older than me.
I don't know.
Are you?
40.
Sure.
I'm 40 now.
Oh, team, he's 3 years older than me. It's wild.
Either way, I'm older. I'm a white guy from Newcastle.
Older and wiser.
And you're a young inner city lass, and we just see the world through different lenses. We appeal to different people.
Yeah.
And I think I just want people to be engaged with their money, because someone might not like listening to me.
Or me.
Or you. Mm-hmm. But just bear with us for this episode, because if you don't like either of us, that's fine. We want you to hear the undertones of what to do when the market effectively poos itself.
Has a wobble.
Has a little wobble. So I might leave that intro there. We're also filming this. It will be on YouTube. I'll probably get it up on YouTube today, but there will be a link in the podcast show notes to this episode. And the reason I say that is I've got some slides that I want to talk through. And I know sometimes I'm a visual learner and a visual explainer. We'll do the best that we can to talk people through if they're driving. But if you want to go home that night and have a look at the slides that we've prepared, and by slides, I mean, I think I've got 4 of them, it will be on YouTube.
Cool.
So we'll leave it there. What you'll hear when I press stop or whatever right now will be the intro music to Jess's podcast, Financially Fierce. Over to you, Jess.
It is a wild time. And in wild times, we need to adapt and respond differently. So for the very first time, I've actually got Glenn James, who is I don't even know what you would call the director, founder, CEO.
Podfather, if you will.
Podfather. Oh my God, you've said that before. The Podfather, who runs the Money, not only podcast, but community more broadly. And you've got, I don't know, however many, 7?
I think there's 7.
Podcasts
Yeah.
Under your umbrella. We are recording this. I think this is quite important and pertinent for today's episode. We're recording this on Saturday, the 5th of April. If you have been watching the news, you will know that these have been some interesting days. And so Glenn and I were already going to have a conversation around investing through challenging and uncertain periods. And the last 24 hours has provided us with a lot of stimuli to have a conversation about, to the point where we have actually created, or Glenn, I should say, has created a couple of slides that we're going to chat through today. We've got a link in the show notes to the YouTube. I don't think we've done YouTube for Financially Fierce, so we're entering a whole new territory.
Okay.
So if you're watching this on YouTube, you'll understand what we're talking about because you'll be able to see the slides. If you're driving the car, don't worry, we got you. We're going to try to explain it. But if you want to go home and hear us again, see us again, make more sense of it all, there is a link in the show notes so that you can get onto the YouTube clip. Glenn, thanks for being here.
My pleasure. Thanks for doing your podcast. It's great.
Thanks for having me. Literally, thanks for inviting me to do a podcast. I remember Glenn offered it to me and I was like, I don't know how to do a podcast. Are you insane? But it's been over a year. It's taken me over a year to invite you into my house. So welcome.
Thank you.
It's a strange time, particularly today as we go to record this. And I know that this isn't coming out for a little while, but, you know, I think it's still extraordinarily relevant. And so because there is a lot of fear, and when we see a lot of fear and we see some wobbles and we see markets which, you know, overnight have reduced, what did you say, something like 5% overnight?
Yeah, like we woke up this morning, it's Saturday the 5th, to the S&P 500 negative 5.97, call it 6%.
Yep.
That will mean the ASX will open lower
On Monday,
the 7th.
So what I want to do today is I want to go through this beautiful slides that you've created to help people understand, what does this actually mean? What do we need to think about? But I also then want to go through some questions around behaviourally, because we're going to talk up front with the slides around sort of the factual information and give you some data that I think is really helpful in these times. But I do then want us to talk through, from an emotional and behavioural perspective, what do we need to consider? What do we think, you know, lends itself best? So we're going to kind of have an interesting, different episode to how we normally run it. Without any further ado, shall we kick off with your beautiful slides?
Yeah, let's do it. And I will do the best job I can of explaining what we've got here. And I think the first thing that I want to talk to you about, Jess, is not selling down out of fear, out of panic. And I just want to illustrate why it's important to not, and you've heard people say, crystallize the loss. All right. So if there was a portfolio of $10,000 and there was an 8% drop in that portfolio. Now, I say portfolio because it might just be 100% Aussie shares. It might be 100% US shares. It might be 100% property. It might be your Hermes bag collection. How do you say the name?
Oh, you're asking the wrong person. Hermes?
Hermes. There you go.
Send us, let us know. We don't know.
So if the portfolio dropped 8%, the actual value of your $10,000 would be $9,200. Okay. So what happens is, at the moment, you're sitting at a paper loss, which means that it's quote unquote not real, but also you can make it a real loss by actually selling at $9,200. So what that does is, they say it crystallizes that loss. So it turns it into from a paper loss into an actual loss.
Yeah.
Now, for the example, what we might say is, you've got 10 shares in a company worth $10,000, $1,000 a share. So each individual share has reduced by 8%, leaves us with $9,200. So we've got each share is now worth $920. Now, if we just wait it out, there is a chance that that $9,200 package or parcel of shares will increase again.
Mhm.
Okay. But the thing is, with compounding losses and the more savage that losses are, it could take 8.7% return to get back to where you were at $10,000. And that's a mind F.
Because people have to remember that we're talking about a return requirement on that $9,200.
Yes. Not anything else. Like
Yes.
not the $10,000. It's gone. The number's
reduced.
gone. It's reduced. So we now have to say, how do we turn 9,200 into $10,000? We need an 8.7% return.
So because you're working off a lower base, it's got to work harder, a la return more, to get us back to that
Yes.
$10,000 threshold.
Yep. And the reason we don't want to sell is because if we have invested for the long term, or if it's our superannuation, or even you might have a pension account, you might be 60 years old right now, and your money is invested in a pension account, you don't need to touch it tomorrow because you're still going to need that money to work for you for the next 20 years.
I was like, you've got 4 years, statistically speaking? Yeah.
So if you actually sell the $9,200, that's locked in, crystallized negative $800. You've actually lost the hard cash.
And you've taken yourself out of that market.
Yes. Now, the trick is people say, well, I'm going to do that and reinvest when I get to the bottom. You might get lucky, but most people, most of the time, when they go to time that market, they miss the recovery. And when it's all said and done, 2 years later, they're still worse off than just leaving it. Jess, I'll show you the next slide here, and we won't need to spend as long. If that $10,000 was a higher risk portfolio, you'll see a 20% loss reduces it from $2,000. So it's a bigger loss.
We're in like a bear market sort of environment.
Or a higher risky, high risk share or asset.
Sure.
That reduces it to $8,000. Again, we don't want to sell down and take the loss and lock that in. We just leave it. But we know that because it's a high risk investment, it's reduced more. It's going to need a longer recovery time to get back to the $10,000. And that means if I had $8,000 and I wanted to turn it into $10,000, I need a 25% return.
So we've got a $10,000 starting balance. We have a reduction of 20%, which gets us to $8,000.
Yeah.
To get that $8,000 back to the $10,000, what we don't need is a 20% increase. We actually need a 25% increase because we're working off a lower base.
Exactly.
The point I want to make here, because we use the word loss, and we use a lot of language in times like this that I think can be misconstrued or misunderstood. From a share perspective, from an ETF perspective, I think it's really important to stress to you that unless you've sold out of something, to your point, you haven't lost anything. You still retain the same amount of shares, the same amount of units in an ETF, whatever you've got. It's the value that's gone down.
Yeah, the face value, if you will.
Correct. It's like you've bought something on sale. You're still getting the same amount of things, parcels. It's just that it's at a lower cost. Yeah. I think that that's really important because people say, I've lost money. I'm like, you haven't lost anything because you haven't done anything yet.
That's right.
To your point, when you then make that sale, crystallize that loss, that is when it becomes true and real.
A lot of people don't realize, and I'll use the basic example of that $10,000. If I had 10 shares worth $1,000 a share, and that share or that company would pay a dividend based on each share that I've got. If the face value reduced from $10,000 to $8,000, I still get a dividend based on me having 10 shares.
Sure. I mean, the counter argument to that would be, well, if the value of that has gone down a lot, you could argue that perhaps something has happened within that business and the dividend or the distribution is going to be lower.
Economic factors and all that. But in theory,
yes,
when you look at share price charts, it's literally just the share price chart. If you want to have a look at the real return of equity markets, you need to use what they call an accumulation index, which shows you what the value is with dividends reinvested.
Yes.
Because that's the real return of the asset.
Yes.
Not just the share price.
Well, there's a combination of things going on. And not all investments provide income.
Absolutely. So the next slide that I want to go to is a bit of a snapshot of they say past performance is no indication of future performance. I kind of say, well, kind of is-ish. here are three major crashes that you may remember, and I'm going to talk you through the crash, the index, how far it dropped, and how long it took to recover.
And we should say, when you're talking about the index, you've split this by how it impacted the S&P 500
Yes.
versus how it impacted the Australian stock exchange, so the ASX 200.
Yes.
Which I think is fascinating because these are interesting insights in terms of how they do not necessarily line up in terms of time to recovery.
That's right, and we can talk about that. So let's now have a look. So the dot-com bubble, that was from 2000 to 2002. And this is the interesting point, Jess. The S&P 500, which is a weighted index of effectively the top 500 companies in the US on any exchange, the peak through decline was about 49%. Okay. So, and then what happened was the time to recovery to get back up to where it was about 7 years for the US stock market. Now, interestingly, the ASX 200, remember the dot-com bubble, that was very tech heavy. You know, I could do a website, petsrus.com. We were a tech startup for pets, and it would have went through the roof because even though it had nothing, it was just the hype, everything, tech boom, you know, and then bust. The ASX 200, which is the top, a weighted index of the top 200 companies on the ASX, Australian Securities Exchange. By weighted index, I mean if it's not 200 companies spread out equal weighting, it's literally if CBA is 7% of the ASX 200, 7% of that index is CBA, for example. That fell 21%. The interesting thing was it took 50% of that index recovered within a week. Okay.
Wildly different stories in this occasion.
Why is that?
Well, I would imagine that Australia's largest 200 companies didn't have as great of exposure into sort of the dot-com situation.
Australia is banks and holes in the ground.
I need you to know I was, I think, starting year 7, so I wouldn't say I'm fully across exactly what was going on in 2000. I was off, doing the Olympics, so I was very busy training for the closing ceremony of the Olympics, as a side note. But that is my guess. Is that correct?
Yeah, basically, yeah.
Okay.
Now, the GFC, global financial crisis, that went from 2007 to 2009, so a 2-year period. The S&P 500, about 56.8%, took 4 years to recover. Our ASX 200 dropped about 50% and took about 6 years to recover. The most recent one, I might get you to just move that mic back a little bit from you.
I can move myself back. Yeah.
I'll just do that.
Sorry, because I'm leaning forward.
No, that's fine. I just don't want to
eat it.
Yeah, and so the US S&P 500, the 2020 COVID crash, you'll see here, dropped about 33.9%, call it 35 if you want to round it. And that took about 5 months to recover, okay? Now, this is the interesting one. The ASX 200 dropped about 36%, and that took about 14 months to recover. Now, within this, the reason that I wanted to kind of talk about this, any kind of content that I do, and I'm sure you're the same, and I have no control over the content Jess produces on her podcast. She has complete editorial control. The reason why it's important to say this, I tell people we do not invest in shares if you need the money within 5 to 7 years.
Sure.
Because when stuff goes down, it could take 4 years to recover. It could take 14 months to recover. It could take 5 months to recover. It could take 6 months to recover. It could take 7 years if you were invested in the US in 2000. So the reason that's important to know is because if you do have that pension account or an account-based pension and you are 65 and you suffer a loss in that portfolio, that's okay. The money needs to be invested for another 5 to 7 years. I had lots of clients in the GFC, their share portfolios dropped maybe 30%. And you might say, well, why is it 30%, Glenn, when you just said the GFC S&P 500 dropped 56%, the ASX 200 dropped 50%. And we're like, you said 30%, Glenn. Why not 50? We'll get to that soon.
Yeah.
They sold out of fear, and then they sat in cash for years, and it cost people hundreds of thousands of dollars. And that's a big thing we need to know. We do not react. We do not sell out of fear, because this is the worst time to sell down, because it's going to take longer to recover, and we don't want to lock in those losses.
But also, you're not buying on sale, potentially.
Exactly. And that's the counter discussion. Now, my next slide, if we move to here. So this is a portfolio. A lot of us with our super or pension accounts will have a portfolio. It might be called balanced. It might be called high growth. It might be called growth. I've made this up. It's literally doesn't exist.
For those playing along at home / in their car, this is a pie graph that I'm sure you're going to explain, but just so people are following along.
It's a round pie graph.
All blue.
Yeah, there's some shades of blue and light green and all that.
Okay.
But this portfolio is 83% growth and defensive 17%. So we'll call it a high growth portfolio. Now, this portfolio is made up of 33% Australian shares and 42% global shares, which would primarily be the US and pretty heavy. You can look on your own Canva if it's too hard to see over there.
Oh, yeah, I've got my own.
That's why I shared it. It's a long way to look over that preview monitor.
Yes.
So in my last ramblings, when I said during the GFC, people were shocked because their portfolios fell 30%, which is savage, not going to lie. But the reason why their portfolios likely didn't fall the 50%, because they didn't have 100% of their money in Australian shares only or global shares. Most people in their superannuation have a diversified pot with different asset classes. So Australian shares 33%, global shares 42%, property 75%.
No, 7.5%.
Sorry, thank you. Yeah, property heavy portfolio. Property 7.5%, infrastructure 7.5%, and then cash and bonds 9.4%. So what that means is, if we go to the next slide here, I will try and explain this if you're driving along and not on YouTube. It's an XY axis. I made this portfolio up. Looks like a heap of spaghetti going down from the left up to the right.
It does, in different colours.
In different colours.
Yes.
So what we want to show you here is the things that I talked about in that portfolio is cash and bonds, which is our defensive assets, Australian shares, global shares, property and infrastructure. And they all kind of squiggly up and to the right. The solid line the straightest line that is yellow or orange, the smoothest, thank you. That's our cash and bonds, defensive. So if you look at point arrow 1 there, everyone watching, that's at the bottom left of the axis. You can see there that cash is less than, say, global shares and Australian shares. So at the time, year 0, I'm like, yep, shares are going well. Cash is 4.5% return. I know the shares are going to do 8%. I'm going to invest in Australian shares or global shares. Awesome. You look 10 seconds later, the shares are going up higher than the cash, right? But if we go to the second arrow there with number 2 that everyone can see, just under year 5, the shares and the property is lower than cash because there might have been a Trump tariff put in year 2, which effed the market irrationally. Don't get me started. Also get me started.
Yeah.
Now, what the thing is here, a lot of people will invest and the first 6 months might be, yeah, this is awesome. I'm going to put more money in, but they haven't got their setup correct because they might think, well, I can get 8% from this investing portfolio instead of 4% cash. But we need to know, well, we don't want to commit the capital to the investing portfolio for at least 5 to 7 years. So as you can see, the third arrow there, it was just past the 7th year. The shares are now starting to overtake that cash line. Then the fourth arrow at the very end in year 20, cash is somewhat lower than global shares, Australian shares, property and infrastructure. So having said all that, with the previous slide, with that portfolio of a growth 83% and a defensive 17%, you will see that a lot of superannuation portfolios build their own portfolios to try and smooth out all the different markets that do not generally correlate, okay? So this slide here, it's the same graph, but I've put 3 big lines and arrows of blue in there. So this bottom blue one, it's lower than the 2 above it, and it's overlaid over the spaghetti colors from the bottom left up to the right. That could be a portfolio in your super fund that says, we suggest you hold this for 4 years because there's a 50% allocation to growth and 50% allocation to cash and defensive.
So you're trying to show people what the expected outcome might be based on how they're investing their money apportioned to growth and defensive assets.
That's right. Mm-hmm. And for those playing at home who are a bit nerdy like us, Jess, it's basically, this is what we call modern portfolio theory. Mm-hmm. So we build a portfolio with all the different parts to get us a smoother return. And if we look at the next arrow in the middle, it's a 70% growth. So it's cut right through the two, 7-year suggested hold time. Mm-hmm. The top one there, it's 90% growth, 12-year suggested hold time. Mm-hmm. So portfolio managers, so your super funds, it could even be, a Vanguard diversified high growth fund, literally build a portfolio in a box that has an allocation to different assets based on the data that they have. Say, we think this will give you a smooth long-term return, and there you go. But what I want to actually show you, Jess, which I hadn't prepared for this, but I've just brought it up now. Here is an example.
Is this on a slide?
It is.
Oh, yeah, good.
Just keep going on your thing and you'll see it. Just having some tech issues. Okay. So this is 4 super fund high growth options.
Yeah.
And then at the bottom right there is the Vanguard Diversified High Growth Fund. So as a bit of homework, everyone, open your super fund if you can get in, because they were attacked yesterday. But don't stress, because you'll get your money back. It'll be insured. That's a benefit of going to
they're locking them down to protect them. So just know that.
So open your super fund. So this bottom right one here is the Vanguard Diversified High Growth ETF. Mm-hmm. Their product, because you're buying a product, they say, we do not suggest that you invest in this ETF if you need the money in less than 7 years. This one here, they say a 7+ year time horizon. They say it's a high risk. This one here, they say a 10-year. This is where my tin hat comes on with some of these portfolios, but that's for another day. This one here, 12-year. Mm-hmm. I'm not investing. No, I'll shut up. And then this other one here, 10 years. So open your super fund, look at your option for what you're invested in, whether it's a balanced, high growth. Have a look at the website and it will tell you what the suggested hold time is. So knowing that markets over time move, knowing that in every single one of those examples, the dot-com bubble, the friggin' GFC COVID, and the Orange Man's tariffs, we don't know where that's going to end. But the 3 that I said before, history has categorically told us markets have recovered. So how do we reconcile the hurt and the pain and seeing that paper loss right now in our super account? Yeah, Booksmart says, keep your mitts off your super, shut up, turn down the TV, do all that. How do we reconcile the knowledge with the behavior and emotion? It's a good question, isn't it? How do we do that? I just want to double check I haven't missed any slides. I haven't.
Yeah.
So that's kind of my little presentation. Do you want to maybe pay the bills and maybe we can continue this chat right after this?
Yeah, sure. Let's do a break and come back and let's chat.
Let's chat.
Less slides.
Less slide. There's no more slides, Jess.
Oh, great. Let's chat more about
Life
and how we should respond and what we should think about.
Love it.
Did we pay the bills?
Bills have been paid.
Welcome back. Okay, thank you. Glenn said to me before we kicked off, we're two strong hosts and I've got a slide deck. How are we going to do this? And I was like, I don't know. We're just going to wing it and hope for the best. Did we do okay?
I think so. So, Jess, you do the odd episode on my podcast, right? And I think we did one yesterday.
We did.
It doesn't work with two really strong hosts. Like, we get it done. We don't need to prep questions because we end up just chatting. But I think my final thoughts before I hold it back to you, you've got to really, really, really don't react out of fear. If in doubt, just pause your investing for now. But the worst thing I believe you can do is try and get cute with the markets, cute with your portfolios, and think you can outsmart the market. You can't. If you do, we call that luck.
Yeah, I think that there's so much noise and so much fear right now, which is why we are doing this episode. If I didn't have to do this episode, I wouldn't, because I feel like we might be adding fuel to the fire. However,
well, that's why we want to educate without the drama, and that's why we walk people through those slides.
Absolutely, and I think that is what is so needed right now because fear sells. Fear is contagious. Fear sells, and it helps a lot of news outlets, get coverage. And what we actually need to talk about and think about is, well, what does this practically mean for me? Does this mean anything? And how do I behave and what's the next step for me? And I think what I want to start with halfway through our episode is I want you to know however you're feeling right now is absolutely fine and it's valid and it's fair. You're allowed to feel stressed. And what I think often happens, particularly when we have situations like what we have happen now, and we've had an interesting, frankly, amazing ride in share markets over the last, 10 years plus.
Or even just off the back of COVID, let's be real.
Yeah, sure. And so, this is for a lot of people, particularly new investors who have just dipped their toe in the water since COVID. This can feel really scary. But, what I have often seen in situations like this is a feeling of a lot of lack of control. You wake up in the morning and there's some other thing going on and there's another announcement and there's another bloody news headline, and it is completely valid to want to, in some way, feel like you have autonomy and control in your life.
Do you always talk about feelings on your podcast?
Always. Because you cannot run from the fact that money and emotional stuff are interplayed, and it is times like this that help me prove it the absolute most. So if you are not talking about feelings, Glenn, I'll invite you to talk more about your feelings on podcasts.
You tried to convince me into some yoga or something before we started.
I did. So we'll see how that plays out. So let's get into the questions. But I just wanted to say, however you're feeling is absolutely valid. And we're not trying to invalidate your feelings. You're allowed to feel how you feel. What you're not allowed to do is irrationally and immediately make a knee-jerk reaction that might have really big cascading financial implications for you. So, Glenn, let's talk about this. I think markets have been wobbly. That's my technical term. I don't know if you've got a better one. Let's talk about for people who are feeling that wobble. What do you think from a mind? I mean, clearly as the feelings man over here, you've got the expertise to be able to deliver on this question, I feel.
I've got the emotional capacity of a doormat.
Great. Let's go with this one then.
Right.
What mindset shifts help people stay calm and committed when it is that long-term investment plan?
Yeah. So I want you to understand in the mindset thing, and I try this in my own life in terms of my investing, my business, when I'm managing staff, when I'm in a relationship and all that stuff, that it's really, whenever have you had a good outcome when you've acted abruptly from your feelings and emotions?
Probably never.
There could be a streak of passion or lust.
Sure.
Did it end well? Not sure. It could be I optimized this opportunity. I felt it at the time, got lucky, awesome. But most of the time, if we react out of emotion, it doesn't end great.
Mm.
Fear is an emotion. We're scared.
Yeah.
I opened my app, just curious. I rarely open my app, and I tell people to don't look.
Mm-hmm.
I really don't look. I opened it this morning,
Mm.
didn't look at it all week because I just don't care, because I understand what markets do.
Mm-hmm.
And just because I see all this red in my portfolio, it doesn't mean I do anything.
Mm-hmm.
So back to your question, whatever it was, around how do we I'll bring it back. What I suggest, you've got a couple of options when you're feeling scared at the moment. Is that kind of the question?
Yeah. Like what mindset
Yes.
shifts help you?
Yeah. So the absolute mindset shift set is
Set shift?
yeah.
We got, yeah.
Yeah. Well, it's only midday, and it's been a long life, Jess. We need to know I am an investor for the long term.
Mm-hmm.
Like that James Clear Atomic Habits.
Mm-hmm.
I don't go for a run every day. I'm a runner.
Mm-hmm.
So in my life, I've had to learn that Glenn James is an investor for the long term.
Yeah.
So what that means is I know that markets will fluctuate.
Mm-hmm.
When markets are really high and my portfolio says 28% in the last 12 months, I don't react and take all that money and sell it down and hoard cash, and then when it drops again, put it in. No, that's timing the market. We don't do that. We invest for the long term. I also understand that because I invest for the long term, markets fluctuate. I have a strategy. Now, my investing strategy, and this is interesting, when we tip on the mindset, in my book, The Quick Start Guide to Investing, I'll put a link in the show notes. It's a really good book that we wrote about investing in shares. When we talk strategy, right, it's my strategy, Glenn James, is I want to live on less than I earn, be a generous giver, invest the rest. That invest the rest part of my strategy is I'm putting wealth away for the Glenn of tomorrow.
Mm-hmm.
And part of my strategy is it might be every month I invest in my equity portfolio. Now, in my strategy doesn't actually say, what does Glenn do if the S&P 500 drops 6% overnight?
Mm-hmm.
My strategy doesn't say, what does Glenn James do if the S&P 500 increases 5% overnight?
Mm-hmm.
It's not part of the strategy because I understand markets fluctuate. So within that, there's the other side of this coin for those who are really confident with their financial situation, really confident with understanding how markets work. And if you are new to this money world, totally fine to be a bit scared right now. This is why we just need to tell you how things work. We say, because I'm investing each month, you've heard of dollar cost averaging. Over a period of time, if I invested over a 12-month period, $1,000 a month, I put $12,000 in the market. 1 month it might be up, 1 month it might be down. When the 12-month washes up, I've got the average price. That 12-month period then, fast forward 5 years, you've got a cheap buy price for that parcel. So we've got to think long term.
Yeah. I mean, how I think about it is exactly to that point. Like when you are an investor, if you're investing your money, which you are, whether you realize it or not, because you probably got money being invested in superannuation, it's not an if, it's a when. And so I think during these periods, recognizing, this is the when. This is the when we have volatility. And to your point, getting out of our own way and going, cool, I was ready for this. I knew that this was going to happen. I may not have built it into my strategy of how I would exactly behave if a market went down by a certain amount, but I did understand as I was dipping my money into the markets that this was going to happen. Here I am. We've arrived at this period. My best thing to do is to stay the course because I understand the goal that I'm trying to stay on track to achieve. And I keep buying and I get out of my own way and I take, it's so funny because I spend a lot of time talking about how we should create less barriers for our money because we want to automate and we want to, make life easier for ourselves. And yet I actually think in periods like this, we want to create more barriers for ourselves to not do the silly thing. Like take exactly to your point, change your password and save it where it's hard to, get to it, or take the app off your phone. Like build in mechanisms that are behaviorally going to work for you so that you can stay calm, you can stay committed, you understand what you're there for. And this is where I think it's really hard if I bang on about goals so much. I think it would be so much more uncomfortable to be riding out this period and not understand why you'd invested that money. Whereas when I think you have conviction in your long-term goal, I think it would be much easier internally to rationalize why this is absolutely the right thing to do in terms of staying the course. But if you don't know why you've invested, you don't know how long you want to keep that money for, I think it'd feel a lot scarier.
That's right. Now, I'm going to break, what do they call them, like a cardinal sin.
Oh, what are you doing?
Well, I've got another slide.
Oh, he's back. He's back on his slides. Tell me.
Back. So this is a slide. If you aren't on YouTube, you'll see it in that Canva thing. I want you to just Google on Google.
Oh my God. I can't wait to have you back on the show.
Oh my gosh, how embarrassing. Anyway, Google S&P 500. Google will have a built-in graph. I'm showing this graph here. It was pretty much, actually this was at 2 days ago. It will probably be less now. I've hit max. So there's a graph of the American stock market from 2000 right through. There's the GFC there in 2008. Oh yeah, it went down a bit.
You're on a 1 day one, aren't you? Oh no, you're on the max one. Sorry. Yep. Okay.
Then it goes up. Look at that. 2020 COVID. That was a sharp drop.
I don't know what slide you're. Oh yes. Okay. Yep. Sorry.
That was a sharp drop in COVID. Look out here, right kind of now, another sharp drop.
And we should explain for people playing at home, when we're saying sharp drop, in the context of the historical performance, it felt like a sharp drop, but over the long term, it actually wasn't that.
Yeah, well, you look at this COVID one here, and it does look a bit like a sawtooth, like a real savage one. So what would you do, Jess, if you could turn back time and know that COVID would recover markets would recover. What would you do if you could turn back time and say, oh, the market's down. I knew it was down then. What would you do if you could turn back time today?
And I knew what was going to happen thereafter?
Yeah.
You'd buy.
Yeah. Now, you wouldn't buy if it wasn't in your plan, potentially.
Sure. And there were a whole heap of other things. People were losing their jobs. People needed to have cash. Like there's a whole heap of caveats to that.
But if you look back, you would say, sure, I've got some spare cash. I got a bonus at work. I got my tax return back. I'm going to put it in my super. I'm going to put it in my market. I know that right now it's come off because we're looking back, turning back time. We know that it recovered. So what I'm also going to do now, if you want to finish your point.
Well, yeah, I just think the COVID one's a hard one because it's such a short recovery. And I don't think that is it's an interesting example, but I don't think that mirrors the recovery of so many other, reductions that we've seen.
Yes. However, but we know if you zoom out, markets recover.
Sure.
So I've just opened let's make sure I can't see on the camera there. I've just opened my app, right? So one of my investing accounts, it is total return of the portfolio is at the moment, since I started the portfolio, negative 10%.
Okay.
I only started this portfolio in less than a year ago.
Okay.
So I put money in. When did I put money in? July. The first deposit was in, we'll call it 10th of May 2024. So 12 months ago, I started a new portfolio. I had some restructuring in my life and whatnot. It's down 10.97%. That's the total portfolio. I scroll down to one of my holdings. First time looking at this, negative 21%. Another one of the holdings, negative 5.6. Another one of the holdings, which is just the ASX 200, negative 8.7, S&P 500, negative 2%. Must have got a good buy price on that. Anyway, so all that to say, I've opened my app. I've seen that my share portfolio in total is down 10% and it's red.
How are you feeling?
Oh, that sucks. That's annoying. The instant emotional response.
Mm-hmm.
But hang on. I don't need to react or sell because last week I wasn't planning to sell. Why am I all of a sudden planning to sell today? I'm not. So my instant reaction, because I would like to think, I've been investing for 20 years. Can I put some more money in?
It's funny that – oh, sorry, you go.
No. I just know that, well, that's cute that one of the holdings is down 20%.
Mm-hmm.
That's a big hit.
Mm-hmm.
Macquarie Bank. But I know that I've got no plan to sell that.
Can I contrast this with –
do what you want.
I think sincerely – I've opened my investment portfolio, I'm going to say 3 times over the last 12 months. I don't know why, but I had a look at it on Thursday.
Really?
Yes. And what is fascinating is obviously I'm a human participant of the world and I've been watching what's been going on, not intently because my mother has told me I need to calm down with all the watching and spiraling. But I was like, okay, I roughly know how much I've been putting in. I roughly know where it's going and it's like 100% growth investment. So I'm like, okay, she's going to be bashed up. Where are we at? And it was so interesting because when I opened it, I was like, oh my gosh, it looks great. I had I think mentally prepared myself because I, knew that what it was invested in and what the markets have done. I think I had spiritually prepared myself for a much worse outcome that when I logged into it, I was so excited to be like, oh, okay, cool. This is great. And I looked at how many, shares in some and how many units I had in some and I started sort of doing the math and I was like, this is brilliant. So it's really interesting that I had spiritually catastrophized maybe too hardcore. And I don't know whether that was a self-preservation method to then be excited when I logged in. I don't know if that is helpful in any way. It's just really interesting that it only happened on Thursday.
Yeah, that's wild. But I would say as well, embrace the awkwardness, embrace the pain and get used to sitting in it.
Yeah.
That's what my psychologist Lucas told me last year.
Well, good feelings. And I think it is so natural for us to want to cut and run from those. And so it is thus a really natural response to want to cut and run from those uncomfortable feelings, which is quote unquote, my portfolio is down 8% or 10%.
Yeah. And I don't want you to freak out. So you might open your super account. I've just looked at one direct equity in my portfolio, Macquarie Bank, down 20%.
Sure.
Since I bought it. I think I did $220 a share or something like that. Hang on, I'll have a look. I knew that it was probably a bit hot then, but I'm like, nah. Oh no, $220 I paid for Macquarie. And I'm just like, yeah, it's a long-term play for me. It's actually the only direct share that I currently own and it's down 21%. Your super portfolio might not be down 21% because you've got to look at different investments, right? Macquarie Bank, single stock, single sector. Most of the hit in Macquarie is because they do a lot in the US of A. Okay. So when I look at my blended, indexes, the broader index might only show -8.
Yeah.
So your superannuation, I want you to understand, particularly if you're in a blended, like an industry fund or, one of those funds, your superannuation account will have a whole heap of unlisted property assets and they won't be reflected in the value tomorrow. So you won't feel the hit as soon as possible. If you are listening to this and you are over 50 or 55 or 60 and you are looking at retiring soon, I don't want you to stress. Just don't get cute and log in and sell down now. I want you to get financial advice and get a plan in place. The worst thing you can do is sell down to cash. There's people in our Facebook group who are in their 30s and we get questions. Should I move my super from growth to safe? No. Were you doing that last week? No, you weren't. Why are we doing it now? You're doing it out of fear. I understand, but you can't touch that money till you're 60 at least. So you just need to let it do its thing. Each month your employer contribution is going in. You are getting lower buy prices in your super.
I also think if the portfolio is called safe, that's very misleading because short-term safety, quote unquote safety, to provide less volatility in that turbulent time, I would strongly argue it creates or provides a situation where it is not safe because you are then sitting on the sidelines for too long and you've missed out on growth opportunity. I think that's a labeling thing, but important. So that probably brings me to a good point. Like, let's talk practically.
Yeah.
What does a quote unquote good investor actually look like in times of volatility? Is, in your mind, it more about what they do in these times, or is it more about what they don't do?
A good investor in these times of volatility, you could be a cardiosonographer as your job.
Okay.
Cardiac sonographer
Okay.
as your job.
Sure.
I just picked a career.
Yeah.
A good investor who's a cardiac sonographer, Monday morning gets up and goes to work.
Great. So it's, and I think I agree with you. Well, I do agree with you. I was going to say, I think first and foremost, a good investor in these times is first and foremost about what you don't do.
Yes. Thank you.
And what you do comes next.
Yeah. So we don't react. We don't sell down, because if it wasn't in your strategy 3, 4, 5 days ago to liquidate your portfolio, I dare say it's probably not in your strategy to do it now.
Great. And I think that's so important because everyone is, constantly talking about, how to make hay when the sun shines or buy the dip or, whatever. Actually, up front, what is probably more important is don't do any of the big things incorrectly. What you don't do here is wildly important. Okay, there are lots of people who perhaps had to start investing this year and now are sitting watching the news or just watching anything, frankly, and thinking, I'd hit my emergency savings target, or I've replenished my emergency savings, because we know over the last couple of years quite a lot of people have taken a hit to that, or I've got myself out of credit card debt and built up, a safety net. I was meant to start investing now, but now I'm worried I shouldn't.
Yeah, look, I would probably say if you're a new investor and you've met those milestones, as you said, emergency fund and all that, I would probably, and this is a broader economic thing, we could see a US recession. It's highly likely.
And is it fair to say if we saw a US recession, it is likely that would ricochet into other parts of the
Yeah,
world?
absolutely. So the biggest thing there is the tariffs on China. Everything is made in China. It's effectively a trade war now. Other countries will do retaliatory tariffs.
Yeah.
Yep. So basically, if you were a business and you employed 5 people and you knew that this was happening, would you take this time to take your money in your business and invest in new staff, knowing that all this uncertainty?
I think it would depend what the business is.
Yeah.
Because the argument is, I think from him, well, we want to make America more competitive on a global scale, so that probably no, because I'd probably have some fear around making sure that actually would make sense. But there's a counter argument of, well, actually, if tariffs are going to mean that imported goods are going to be comparable to US costs, then there might be more competition that creates more value for the economy, which creates more job opportunities, which is what he's talking about.
Yeah, and any economist in the world who's got a brain basically said tariffs don't work. They literally, it's a tax on people. And anyway, all that to say, if you are just starting, I would say it's okay if you are a new investor not to start right now.
Because you're worried that they will have an experience where it goes down soon after they put money in and they become gun shy?
Yeah. Or it's a good predicament. if you said, I've got $500 and I want to start investing tomorrow, I would say, okay, well, let's just put half of that in a well-diversified portfolio. Or let's do it $100 a week for the next 5 weeks.
And dollar cost average it in.
Yeah, and the data says a lump sum in the market will outdo a DCA, but I used to do a DCA with my clients for the psychology walking into the water. So yeah, I don't 100% know the answer to that. It's a good time to learn. If you are a new investor from the start of the year, this is a really good time. We train for this time. This is what we train for.
Yeah, this is the when.
Open your app, see that it's all red. What? Macquarie's down 20%. Oh my gosh. Don't panic. Lean into it. This is what happens with financial markets. You look at the charts. They've always recovered. This is a weird thing, Jess. The Great Depression. Guess what? Financial markets recovered. We've just
took a long time, though.
Yeah, that's right. And that's why the 3 examples that I shared, .com, GFC, and COVID, the longest amount of time for the market's recovery was 7 years.
Do you read? I can't remember if you read.
I listen to audiobooks.
One of my favorite books on this whole
We probably should wrap this up as well.
We need to wrap it up. And so in case there is anyone who is also a nerd and wants to lean in and actually have your point proven, not only over the last 3, but over however long. Have you read The Ascent of Money?
No.
By Niall Ferguson?
No.
Highly recommend, particularly during periods like this. So if you're a new investor and we are going to use this as our opportunity to learn and educate yourself, obviously listening to podcasts is awesome. If you don't believe us and if you want to see and you want to go back, it talks about the creation of the share market. It talks about what created the great, what they think that, one of the big crashes in the US around the Great Depression was actually started by, which is fascinating and insane and wild and genuinely unbelievable. Great read. Highly recommend.
Yeah.
Because I think it really does do a really good job of proving everything that we've been talking about today, and to not only look back over the last, 25 years, which is what we've done today, but it looks back at, over 100 years and helps create a level of certainty for people that, we're not new. This is not new. None of this is actually exciting because this isn't new. Sure, something different might have caused it, but this happens all the time. It just has a different flavor and a different feel every time we experience it.
And I think the problem is what Trump has done is it's like the first time in over 100 years where a sitting US president has literally inserted, actually, I'll read this quote. It's a really good quote from Sagar and Jetty. He hosts the podcast that I listen to in America called Breaking Points.
Okay.
This is the most extraordinary tariff action in over a century, probably the single most economically impactful action that a president of the United States has ever made in terms of direct intervention into the economy.
So he's not saying it's neither good or bad. He's just saying it is one of the most impactful.
He's saying it's bad. In context, if you listen to him, yeah,
I don't know,
and that's why I just want to be cautious. Like, if I was a business, I'm probably just holding my pennies a bit tighter at the moment, because if China slows down, we all slow down. That's the wild thing. Now, markets will recover, and the economy, and I've got an economist coming on the Money podcast in the next couple of weeks. We'll talk about this.
Sure.
But markets usually will go faster than the economic experience on the ground or whatever.
Yeah.
But yeah, this whole thing is, and the way that he effectively made the tariffs, they actually weren't reciprocal tariffs to people who were having tariffs on the US. They literally made up some dumb algorithm from ChatGPT and made a number from the trade deficit and put that tariff on. It's economic.
When you say it's from ChatGPT, do you actually mean that?
A lot of, like, this podcast that I listen to, Breaking Point, it's a really good podcast. It's an American political podcast.
Sure.
But the host, Saga, he's a Republican. The co-host, Crystal, she's a Democrat. They're not far left and right. They're like
Center.
reasonable, normal people, journalists.
Mm-hmm.
Like Crystal's like, this is economic terrorism. So Trump likes trade wars, and the problem is he can now use this to his advantage with negotiating to other countries to say, we will reduce that tariff if.
I also feel like just the level of like the velocity, I don't know if that's the right word, or like ferocious. I just feel like we all have a bit of whiplash because this has just been such intense change so quickly.
Yeah.
And, you know, it's scary because, you know, we've just come out of something where COVID was quite quick and, you know, we all felt like our head was spinning. Different but same.
Yeah, so the reason they reckon, and it's, you know, you look online, a lot of top people, the reason they reckon that it could be a ChatGPT crack job on these numbers is because the list of countries, they mentioned an island off Antarctica.
With the penguins?
With the penguins. That's a territory of Australia, but they've put this island or whatever brackets Australia, a tariff on that island.
We should explain. There's no one nor nothing really happening on the island except penguins living their bestest life who do not deserve tariffs.
No, so they like the whole thing is just ridiculous. And, you know, I was calling it, and we should end because we're getting into opinion on politics, but I was like, look, I don't know how long Elon will actually last because I was watching Trump's presser. I don't even think he mentioned cars at all. Is part of his Tesla thing and all that. Like, I don't even think he mentioned the word Tesla in his Liberation Day speech at all. And you've got to remember, with this Liberation Day crap that he's doing, a lot of the stuff that he wants made in America, the parts have got to come in from overseas. Like, sure, turn America back into the 1950s, but a lot of the supply chain is, sure, it's manufactured in America, but the parts have got to come in.
And where do they get the raw materials to make those parts?
Countries like Australia, Brazil, all around the world.
And I think this is where people forget that the global supply chain stuff, because people just see one particular economy and they just sort of see it in isolation. And we are a global beast.
So things might slow down. Again, we don't live in fear. We live in terms of our money. We always want to make sure we're out of consumer debt and not having consumer debt. We always want an emergency fund for emergencies.
Yeah.
We want to just be methodical with our investing. If you want to, you know, if you do your budget or spending plan and you have money left over that you want to put to work, well, we can invest for the long term. Now might be a good, quote unquote, buying time, but we're just not reacting out of fear and selling down to cash.
Yeah.
Just keep your mitts off your super.
And I also think in these times, and we will wrap up because this is, I've been threatening to make my episodes shorter and it's just never happening, but it is getting long. I think, you know, today you've kind of debated yourself because I didn't bring slides to have a counter opinion, and nor do I have a counter opinion. But I think you've made a really solid argument for being rational and being logical, which can be really hard when you don't want to be rational, you want to be emotional and throw your, you know, toys out of the cot. But I also think from what you've learned today, hopefully you've learned some things that help you feel calmer. Who else needs to hear that? You know, when you're having conversations with people and they're saying, oh my God, have you watched the news? Like, what are the things that you can respond with? Because this is not, you know, this shouldn't be a secret. And yet I feel like it really is for the privileged few people who lean into personal finance or who listen to podcasts like this. Actually, we want to share this with all and sundry because this can really erode years, if not decades worth of wealth, of retirement savings, of people's ability to achieve really big, important life goals. Like, just make sure when you're hearing people have conversations where they're talking about being scared, they're talking about behaving in a certain way, either share the episode with them, send them the YouTube link, or just really impress upon them that if you weren't planning on doing it a few days ago, weeks ago, etc., you probably need to do some more research because it's maybe not the right thing to do.
And if you are in your 50s and this whole like retirement thing, it's really good to start to look at your next 8 to 10 years with an advisor now, because then what you kind of do is as you get closer, you can work things out. So if things change or it might not be the best time, you're like, I'll just work another 6 months or something like that.
Yeah, but also it's not an all or nothing.
No.
Like, you can look at bucketing approaches to how you
Absolutely
set up your money so that you're not fearful and you understand your strategy more broadly.
Yeah.
It's been a weird episode, if I'm honest.
Yeah. Do you disagree with me on anything or?
No, I just want to do a little bit more. I want to go back and read a lot. Warren Buffett years ago came out with like Slumberville versus, do you remember this? Around the different islands. Anyway, I want to go and do some research on that because I think it was kind of a point around the fact that we might get to where we are today and the predictions around that. So I reserve the right to change my mind or just expand on that. But no, I think Squanderville actually is what it's called.
Yeah.
No, completely agree. And it's been nice to have you on.
Thank you.
Thank you for hijacking and providing us slides.
Thanks for doing Financially Fierce.
I appreciate the opportunity. And if you have questions, I'm going to send you straight to the Money Facebook community to ask them. Otherwise, you can DM me, Jess Brady _financial advice. Or Glenn, where do people find you?
Don't find me.
Great. Good one.
Money Podcast on Instagram.
Wonderful. All right. That's all for today's episode. Thanks for joining me. Sincerely.
No, my pleasure.
All right. You know what to do. Go now and be financially fierce. Bye. Bye. So long.
Well, it didn't change. Hang on. Say bye.
Bye.
To the camera.
Bye.